Everyone, I'm going to give you my reaction to the Fed's interest rate decision as well as their plan for the rest of the year. This is their press release. And right here, in support of its goals, the committee decided to maintain the target range for Fed funds at 5.25 to 5.5, widely expected today, right, Mo? I think it was like 98.5% expected. No change today. But they had a lot of comments to make. First one, recent indicators suggest the economic activity has been expanding at a solid pace. Is it possible we have this infamous soft landing that not many of us thought could actually happen, including myself?
Including myself, too. It's possible, I guess.
Who would have thought that inflation would be so high and they would raise rates so quick and so fast and it would actually still be okay? You know what?
I know.
Here's the thing they're talking about. They seek to achieve maximum employment and inflation at the rate of 2% over the long run. These are the Fed mandates. These are the two mandates they have. Guys, I hate to break it to you, the Fed should not care about your stock account. Their job is maximum employment and inflation at 2%. And that's core inflation. That excludes food and energy because of how volatile they are. Let's go a little bit further. Now, the committee judges that the risks to achieving its employment inflation goals are moving into better balance. That's a very cliche statement. It is very true. Unemployment rate is still low, 3.7%. And Fed Chairman Powell specifically said that there are far more demand for workers than workers available. And that means inflation. I think that's what he's really worried about. Think about it. Mo, you and I have talked in recent history to a lot of business owners out there, and the biggest complaint is it's hard to find good workers right now. What that means is, go ahead, Mo.
Good workers that stay. Really.
Yes. So you got to pay your existing workers more money to stay, and that's inflationary. If my cost as a business owner goes up, your cost as a consumer is going to go up. That's just reality. That is inflation right there. And that's what we're seeing right here. And that is their concern. Even though we saw 2.9% on the most recent core inflation number, which was phenomenal. It was a big drop from the previous month. But you still see these issues with the labor markets. 3.7% unemployment, guys, is phenomenal. Absolutely phenomenal. To be under 4% for this long is incredible. I'm actually surprised it's not even more inflationary. That's probably what helped keep this economy a little bit going, was there was so much pent-up demand for more and more workers that were good. And maybe that's when you increase your interest rates by so much so fast, that pent-up demand can dissipate a little bit, but it still allows the economy to still continue growing at a slower pace, which the Fed actually does want.
Yeah, and if you look here at the end of the second paragraph, the economic outlook is uncertain, and the committee remains highly attentive to the inflationary risks that are out there.
Yep. So they're basically saying, guys, anything can happen. You know, Mo and I thought, we were laughing, like, soft landing. We've heard this a billion times before. Soft landing, soft landing, soft landing, no chance. Whoops, maybe that was a soft landing. And if it was a soft landing, I don't necessarily give Powell credit for that. He did a great job of, the thing I think Powell deserves the most credit for is, in the face of the public saying, don't raise rates, he said, I'm raising rates. But now he recently said, listen, guys, it's far more important for me to control inflation than it is for us to lose jobs. And remember, Mo, when he was on Capitol Hill talking, we didn't think unemployment would be at 3.7% with rates this high this fast. This has been a miracle.
Never did I think that this would be the case.
Absolutely not. Now, one thing they do write in this press release that I want everybody to focus on that I don't think gets discussed enough, the committee's assessments will take into account a wide range of information. Guys, their job is price stability and maximum employment. What does maximum employment mean? It doesn't mean 3.7%. Trust me when I say this. They don't like 3.7%. Now, with our aging economy and over time, that might be a more standard unemployment rate. But as of right now, we're still a growing economy with growing people, and still more and more people are coming into this economy. I just don't believe that they want 3.7% long-term. Fed Powell said it on the committee. Somebody looked at him and said, what are you going to tell the 2 million people who are going to lose their jobs because of your policies? His comment was, the 100 million families out there, they're going to have inflation, or it's going to hurt them a lot more than the 2 million people who are losing their jobs, which still stinks. But the 2 million job losses didn't happen. But his job, he really does want to get, from what I remember from my economic classes in college, 5.5%, give or take, is about where they want to be for unemployment. It allows people who are unemployable because they're not willing to get more skills to stay unemployed and go in and out of very low skill jobs. It allows the people who have good skill to really go in there and invest in themselves, get better paying jobs. And one thing that we overlook is business owners. It's easier for business owners to pay the best people well when unemployment's like this. So if you're a great worker, you should want higher unemployment. You should absolutely want that, because it's frustrating to see the person next to you who's lazy get a better paying job, even though you're the one working hard. Mo, am I wrong?
No, you're absolutely right. It's so true.
I always tell people, if you're good, you should want tough times. You should want higher unemployment. If you're a good investor, you should want worse times. Now, I know everybody says they want rate cuts, but you go back and look at the history of rate cuts. It usually is in alignment with a recession. So you have to ask yourself, do we really want rate cuts? Guys, there is a benefit to higher interest rates. Now that cash sitting on the sideline can get a pretty good return on your money. Like, you're looking at 98 treasuries at 5.4%. You can park cash for an annualized 5.4% per year. Why is that a bad thing?
Yeah. So over the past almost 2-3 years, the words inflation, recession, and interest rates have just become, interest rates, anything above zero has just become the devil.
Yes.
And that's not how we should be looking at this stuff. And everybody is so one-way minded on all of this. And I get it. The media just shoves it down everybody's throat all day, every day. So you focus on it. But yeah, it's,
well, plus people,
things to happen.
Plus people like paying 2.5%, 3%, 3.5% of their car loans, their house loans. I get that. But guys, wouldn't you rather just get a higher rate of return on your money, on your cash sitting on the sideline? You get cash sitting on the sideline and you might sit there and say, well, yeah, but stocks are going up. Well, maybe so. But I think for the rest of the year, guys, I think it's going to be a situation where Powell really needs to look at the data. I don't like the fact that he said not till May or June, because I feel like that puts him on people saying, well, you said May or June. What are the odds makers saying right now, Mo, on your CME group for rate changes in the future?
So this is actually really interesting. We are looking at saying 64.4% say that we're going to sit where we are at the next meeting, which is in March. That number was in the 50s before Powell said that. So you just did see it move. When you go to May, let's see what May is. May is when they're predicting that their first cut is going to happen. 58.8% chance right now. 9% say it's going to stay the same. There's some people that are predicting a 0.5% cut coming in May, but I don't know about that one. That seems aggressive, don't you think?
It seems pretty aggressive, but again, you know what's worse than inflation? Deflation. So you better believe if we get so low on inflation, sub 2% for some, I mean, I saw the drop last month and I was like, oh my God, this core inflation number plummeted 1% from 3.9 to 2.9. And it was only at, I mean, it's on pace for the 1 to 2% range for the year. But guys, what we always talk about in this channel, and if you're new to watching us, this is why I want you to stick around. Guess what this means for your financial future for the next 30 or 40 years? Absolutely nothing. It should not affect you one bit. You might sit there and hear that and go, wait, what is this guy saying? How does that affect me? If you live within your means, if you save and put in dollar cost average and low cost ETFs, and you have a long time horizon, 10 plus years, your job is just to save. That's it. Markets are going to go up and down. Look at the history of the stock market. You have 15, 20-year periods where stocks go nowhere, 15, 20-year periods where stocks skyrocket, 5-year periods where they go nowhere, followed by, guys, your job is to buy along the way. Don't worry about all these news. Guys, we've been through assassinations, wars, world wars, terrorist attacks, and guess what happens? The U.S. economy does better. The top 500 companies in the U.S. economy do better and better and better. That is your goal. This is all great. I love hearing about this stuff. I like looking at this thing and hearing things. But at the end of the day, guys, all that matters is, are you saving? Are you living within your means? Are you achieving your financial goals based on conservative assumptions? Every single month, something's going to happen. It's going to have a good outlook or a bad outlook in the future. Your job is to just focus on what you're doing. Guys, I do this chart all the time because it matters so much to me. Stocks are going like this in the long run, but they're going to go like this over time. We did a video on Google, Microsoft, AMD, and Starbucks and their earnings after hours, and literally the stocks did the exact opposite of what they thought we'd do. If you told me ahead of time, Starbucks is going to miss on revenue and profit, and the stock's going to go up. Microsoft and Google are going to crush on revenue and profit. Stocks are going to go down. I said, you're crazy. And that's exactly what happened. It's nuts. In fact, Google was down 6 or 7% at one point. So you can't predict what's going to happen. What you can predict is how much money you can put in the market. And along the way here, guys, if you keep dollar cost averaging, guess what you get to do? You get to sleep very well at night, knowing that all the good and all the bad is all evening itself out. And as long as you're a believer in the U.S. economy, this is going to happen. Okay? And for the cash that you want to sit in the sideline, you should want higher rates so you get a 5% return on that cash. 4, 5, 5.5%, whatever sort of banking options you have. So what I want you to do next to learn more about it, we did a video recently called Prepare for Economic Changes for the 2024 Potential Recession. Go watch it. It's going to pop up next. Thank you for your time.